I would start back at your fiat law point, maybe.
Yeah.
Yeah, let's just I'm just gonna make sure that people have us
Mhm.
before we get going here. So just one sec here.
I like this comment. YouTube is afraid of what Pierre is going to say.
That's what it is. That's what it is. They're cutting you off everywhere you show up.
Shut it down. Shut it down.
It's the chair monopoly.
He's talking
Shut
about
it
the
all
U.S. Constitution. Plebes are not supposed to talk about the U.S. Constitution.
Yeah. Okay. People that are in the chat, can you just let us know? Apparently, we had some technical difficulties. Okay, I can see.
We're back.
Yeah, I see us back. I see Russ saying that we're back. So, yeah, Pierre. Sorry. Can you let's just start back with Pierre. You were.
Yeah. If anyone in the chat wants to tell us where it froze up, that way I can just pick from right up there. Yeah, it was censored by the centralized authorities. But I think so. So my point is that the way that we defend ourselves against regulators is by going to policymakers and amending the laws that created those regulators. Ultimately, all of these policy decisions should be made by politicians, right, who are accountable through the electoral process to the people. Because our government is a government by the people and for the people and of the people. And that's the whole point of it, that we live in a republic, in a representative republic, and our representatives are the people that we elect. So we don't elect these regulators to be policymakers, and they are not supposed to be policymakers. They are supposed to be executing policy, which is a entirely different matter than setting policy. So I don't know how we go about it other than going to our legislators and asking them humbly to consider an amendment to all of these laws, reasserting their authority. And if that doesn't happen for whatever reason, then I really think it has to be that we go to the courts and we litigate it, because this is all very unconstitutional. It really is. It's an abomination of the rule of law. It's totally contrary to. Now, okay, so let's talk about another abomination, which is the Stablecoin Act thing. That act is really, in my mind, you know, we talk about the money laundering part, and that to me is kind of the tactical stuff. By the way, if the executive branch, as part of its law enforcement duties and its investigative authority for crimes, if they want data, they need to go to the judicial branch and get a warrant. That is checks and balances. That is what is written in the U.S. Constitution. And so there's no reason that the executive branch should just have a wiretap on everyone in the United States, right? That's not acceptable. And it's been a huge policy debate in Congress, with the NSA and with Snowden and with everything else that goes with it. It really highlights that it is political decision making that's happening, with regards to what the law says. And so there needs to be a political process. There needs to be debate in Congress, right? And in order for there to be a debate, I think that we have to have good legislation. We don't want to debate their legislation, right? If we get into debating their legislation, which is basically financial fascism, then we're just losers, right? Because we're just arguing against financial fascism. What we need to be debating is, how should we amend the U.S. Constitution in order to constitutionally protect running a Bitcoin node? And I think it's already protected, because now we can go to the other matter of, is it illegal to run a Bitcoin node or not? To me, running a Bitcoin node is being the witness to a crime, right? If there's a criminal transaction in it. And so normally being the witness to a crime is not a crime at all. And so there's kind of I think it's infeasible based on the fact that Bitcoin's verification technology, right? It's a way of finding evidence for things.
It's an audit. It's an audit.
Yeah. So we need to put this into law by having, for example, the Library of Congress run a Bitcoin node and archive all of these blocks, and just make it clear that this is the public record, and this is free speech. Yeah. And that would actually give Bitcoin a tremendous amount of strength in the United States if we were able to kind of push legislation that makes it clear what the government's stance is on it.
Yeah, it's interesting because, again, even Bitcoiners coming into the space that are relatively new, when they get to the point where they're looking at running a node, often they'll say things like, "Oh, I'm supporting the network by running a node," but really it's a selfish action, right? Like you're doing it for yourself. You're not really contributing.
Yeah. So let's make it concrete. The federal government seized Silk Road's coins, right? They've got like $1 billion worth of Bitcoin. How do they know they actually have Bitcoin if they don't run a Bitcoin node? They would have to trust Block Explorer or some other third party. Why would they do that when they have the perfect way of verifying that they actually received Bitcoin and that they didn't get scammed, right? And so that to me is the value of running a Bitcoin node, making sure you're not getting scammed. Everyone's trying to scam you. So, lost you. All right, you're back. All right.
I'm here. Apparently I'm slow, but everybody else is good. So, anyways,
okay.
You can keep,
all right. I'll shut up now.
Someone else get out. Yeah, let's toss it. I don't know if I'm delayed. I think I might be still delayed, but I'll just chat really quick. Let's toss it to Greg, and we'll let you take your reason for being bullish, and I'll play around with my connection as you let us know what you're feeling.
Sure. So just a little bit of history. When I got into the financial markets, interest rates in the United States were around 15%, and that's government interest rates in the 10-year, and Canada was higher. And that was in the late 80s. And interest rates since then have gone from 15% in the United States down to close to zero, and now at close to 1% in the 10-year, US Treasury 10-year. This is all to say that we've had a 40-year bull market in bonds, because when I got in, it was almost 8 years into a bull market in bonds. So 40 years. So what is a bond, you guys? A bond is nothing more than a contractual obligation to pay a series of interest payments. And I can guarantee you with 100% certainty that the return on the US Treasury 10-year over the next 10 years will be 1%. It's only math. So before, you were earning 15%, and you were saying, I'm making capital gains in bonds. And I don't want to get into bond math. I think Pierre would love it. We could talk about the duration and convexity of a bond and everything, but really, there is no such thing as capital gains in bonds, ladies and gentlemen, despite what your friendly neighborhood bond manager says. When you take a capital gain in a bond, all you're doing is pulling forward future returns, and you trade in a 15% interest rate for a 14% interest rate. Okay, so it's a contractual obligation to get 1% over the next 10 years, barring one outcome. And this is a non-zero probability, and that's the default of the United States. Okay, so you're going to tell me that it's impossible that the US defaults. I'm going to say it's extremely unlikely the US defaults, but right now in the credit markets, somebody is paying 14 basis points a year in what's called credit default swap or credit default insurance. Point being, the 60-40 model of equity and debt in a typical portfolio is going to rely on a 1% return in US 10 years, and in high yield bonds, right around 4.56% right now. 4.56 is actually the lowest high yield that there's ever been in history. Okay, so let's do a fun little bit of math there. Everyone who owns high yield bonds generally does it through a bond manager because you need diversification. So that bond manager charges about 75 basis points a year. So you start at 4.5%, you subtract 75 basis points, you're into 3% before defaults. There is no return in fixed income for the risk that you're actually taking. So where does this lead? The 60-40 model is basically bust. If you have a prescribed rate or an assumed rate of return in your pension fund of 8%, and 40% of it is earning 1 to 3%, let's say, your assumed return in equity markets is somewhere around 12 to 15%. Guys, the math doesn't add up. Pierre, the mathematician, would just say this is bunk. CalPERS, who has a 8% assumed rate of return, is de facto assuming they can get 15% return consistently in other investments outside of bonds. It's not going to happen. It is not going to happen, and therefore they need to look at other alternatives. And I've been getting regularly pinged by former partners in the business, hey, I need to learn about Bitcoin. Not only am I concerned about fiat and the fact that in a debt to GDP spiral, it is mathematically impossible to grow yourself out of that spiral. I need to know about Bitcoin because of the potential store of value, but more and more importantly, in a debt spiral, debt does not mature, you guys, it rolls over. And in a credit market, the crisis in confidence is the single biggest risk, in my opinion, to the US Treasury right now. You cannot jam any more marshmallows into that piggy bank, okay? Why is someone paying 14 basis points to ensure a default in the 5-year US Treasury? Because there's risk. What if it goes to 50 basis points? Well, lots of countries are at 50 basis points and higher. You can look on a CDS monitor on Bloomberg, or I frequently send them out on tweets. But if the US Treasury default rate in the 5-year went to 50 basis points, my question would be, what is it implied in the 30-year? And without going through too much math, I think that that increase of about 100 basis points, not for interest rate risk, ladies and gentlemen, for credit risk, will knock about 21 points off the price of your 30-year bond. Anybody who's invested in US Treasuries up until this point has never once considered a credit component. It's always been interest rates. Well, guess what? Now you're going to have to start incorporating credit risk. Bitcoin is the ultimate hedge, but look to the credit default swap market to indicate stresses in the system. And Pierre mentioned this earlier. I was involved in a tremendous amount of structured credit in 2008, 2009, Pierre. We had a huge crisis in Canada called the asset-backed commercial paper crisis, which actually, I believe, may have precipitated, well, certainly a couple of months ahead of the crisis in the US. What happened was there was a huge account in Canada, which is called Caisse de dépôt Québec. It's the Quebec Pension Fund. It stopped rolling over its asset-backed commercial paper. And when they stopped rolling it over, this structured credit went from trading at close to 100 cents on the dollar to going maybe a few transactions in the 60s and traded down to 25 cents on the dollar in a matter of months. I'm not predicting this by any means for the US Treasury market. I'm just showing it as a crisis in confidence when debt does not get rolled over. So that's basically my pitch, you guys. Fixed income managers in the world will not tell you that the bond market bull is over, but guess what? It's only math. It is over. And Spain, which just recently was a PIGS, you remember that acronym for Portugal, Italy, Greece, and Spain? Spain just issued at negative rates. I've never heard something so retarded in my life, except because it's an administered rate. So over to you guys. Spain, incidentally, their CDS is nicely positive. Okay, someone's issuing at negative rates, but implied in there is a positive credit default swap rate with a much higher than 0% probability of default. Only math. So lots of people are going to gravitate over from the fixed income world to the Bitcoin world. Bitcoin first and foremost. I'm bullish.
That's great. I'm just I'm double checking on our connection. It's been weird today. I don't know why, but hopefully, again, guys in the chat, let us know. But let's maybe I'll toss it. Unless I see something that says it's not working, then we'll keep going. But maybe this is kind of in your realm, Pierre. So do you want to tag on anything or maybe ask anything of Greg here?
Yeah, I really fundamentally agree with Greg's analysis. I would add that in addition to monetizing fixed income, right, they have also monetized equity markets with the implied put, right? So if stock market goes down too much, the money printer go burr.